We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Rutherglen, PhD level scientist and engineer, and he's also completed his level 3 of the CFA program. He's also the author of the Gold Investor Research Substack. Thanks for joining me again today, Chris.
Yeah, thank you, Tom. It's good to be back after 1 year.
Yeah, it's been a while, and you've been a really busy guy. So obviously, since the last time we spoke, you started your own Substack and provide a weekly update, among other things, for gold investors. So maybe let's start there and understand a little bit more about why you started an actual Substack and what you post there.
Yeah, so the reason I started was the Twitter platform was not quite working out in terms of long form content because it became just unruly in terms of the thread count. I mean, the posts per thread. And in order to clean it up and sort of give a little more leeway in terms of what I can post, I ended up switching to that. So I can show you what I currently have, the recent posts we have, and so one of the things we do with the weekly updates is to look at where the gold price is at, where it's going to be going, what have you. And one of the methods is looking at the options data. Mm-hmm. So in that you can get very sort of fine-grained where the open interests are for each call and put option, and you can form curves such as this, which is the intrinsic value curves. So if the option is in the money, then it has a positive intrinsic value. If it's out of the money, it has a zero intrinsic value. So if you sort of add those up for all possibilities, you get these curves.
Mm-hmm. As part of that, you discussed that the close for gold for the last week was at the upper edge of the empirically derived high probability range at options expiration on December 27th. So where do you determine what that probability range is? That's just based on the options pricing?
Yeah, so I don't have the chart on this one, but I have it elsewhere. And what I do there is sort of look in the past. So during this 2-year consolidation period, what we've seen is that at options expiration, the gold price tends to fall within a certain band. And so that's why it's empirically derived. So it's looking over the past 2 years or so. And, 70% of the times it falls within, 40 million of the intrinsic value. So as you can see in this chart here, the blue portion. And then 90% of the times it's within the red area. So that's just something that one can keep track of, because usually we know that when you get towards options expiration, the price may deviate from it in the interim, but when you get towards it, there's a tendency for it to converge back into that high probability range. Mm-hmm. So I just keep track of that to see where we're at. And right now it's on the outside of just above it. And there's a possibility this week and next, because we're still a few weeks away from options expiration, that it could go a little bit higher. Mm-hmm. But my expectation is if history repeats, the chances are high that it will come back down, probably for a daily cycle low, back into that range, maybe like 1780. But it really depends on if we get that move higher to say 1850 or what have you, 1880 mm-hmm. in the coming weeks. So there's plenty of catalysts this week. We have the FOMC and then the CPI data coming up.
Mm-hmm. And of course,
those definitely could drive it up.
We're recording this on Monday the 12th, kind of the afternoon of Monday the 12th. That'll give listeners a bit more of an idea of timeline of the information that we have available to us right now. And as you said, there's a couple of the catalysts for maybe driving the gold price volatility this week. So maybe explain what those are, Chris.
Well, the Fed's likely to do a 50% basis points increase on Wednesday, mm-hmm. and it's potentially that could be the last one, which we'll get into in some of the subsequent slides. But nevertheless, they're going to do that in the CPI print, and these are both sort of known sort of volatility events that could cause the gold price to go higher or lower. Mm-hmm. And it looks like the bias is towards the higher side for now, and then maybe lower later in the year. So that's kind of where I'm at. I don't do trading. I'm an investor, so I sort of hold positions, but sort of tracking where things are going, which way the wind's blowing, is helpful in terms of making, if you're going to add or move positions around, or it just gives you peace of mind in terms of holding through like drawdowns and what have you. Yeah,
maybe helps you be a little bit more at ease if you
definitely
understand a little bit more about what's happening in the day to day, right?
I definitely agree with that. Yeah, and because you're going to get a lot of noise. Some people say, I mean, there's still some calls that the price could go much lower, and I definitely don't agree with that. But having some of this other perspectives, so looking at any problem from multiple perspectives, you get a richer sense of where things are at and potentially where they're going. So that's what I try to do with this. I don't really give any price targets, but I sort of give investors a sort of supplemental analysis for thinking about the gold price and where it potentially could be going.
So what is that chart, that second chart there that we can see on the screen? The gold price premium and then / discount to the max pain price. What does that chart mean?
Yeah, so there's two parts of it. On the right, left axis is the price premium to the max pain price. So max pain price, if we just go up to here, is the minimum for the intrinsic value. So this parabola, there's a minimum point, and that is called, not by me, but just sort of the industry, the max pain price. And it's max pain for those holding the long positions. So it's max gain for those holding the short positions, but they don't have to pay out as much. And as you can see in this chart, it's sort of been shifting upwards in price, and particularly on the downside. So the downside has been reduced since when I started taking the data on November 23rd. So this chart here is sort of looking at the actual price relative to that max pain price. But the part that I mainly look at is the intrinsic value. So the delta intrinsic value. So that's looking at this separation here and how far it gets above it. Well, I guess it would be this one. So there's a little example I have where, say, if the gold price is here, the intrinsic value is, or the delta intrinsic value is from here down to the minimum, and that's just over that 75. So it's probably around 80 or so. So this data was last taken on the 8th of December, and what we can see is sort of historical track of how it's gone. So there was, on the December 1st, it got well above the high probability zone, and then it fell back into it, and now it's sort of towards the upper end. And on the December 9th, which is not plotted here, but that was the data shown above, it is back above it. So it's not unusual for it to diverge out of the high probability zone, as I call it, empirically derived. But usually when you get towards the end, options expiration, which in this case will be on December 27th, most likely it's going to come back down into it. And then we can sort of see the price ranges here on where it likely could fall. So 1780, which is a possible, what there's been a support in the past, and it could sort of fall back down to that. So it's just, I kind of look at the data, try to put the puzzle pieces together, and then as new data comes by, we'll sort of recalibrate. So that's this chart, just sort of looking at the historical look at it.
So you also analyze the commitment of traders report, and I want to get your thoughts towards how that commitment of traders report has really changed over this past year and how it can affect the gold market.
So usually there's two main players on the non-commercial side, which is managed money. They tend to be momentum traders. So when the price is going up, they're buying. When the price is going down, they're short. And then the other one is called the other traders, and this is more of probably like pension funds or institutional investors, family offices, and things. So large non-hedge funds and non-momentum tracking, and they tend to be more value investors. So they'll buy on the weakness and sell on the strength. What we've seen recently this year is that open interest is definitely down. And open interest tends to track the gold price. And as you can see that in this figure here, And when we got the low, we started to see open interest start to go up, particularly open interest less the spread positions was starting to trend up. And that was an indicator that, the low is in. And now it started to trend back down. But some of that is due to the investors taking delivery on their futures contracts. So December is a large month for deliveries. So whenever they take delivery, they're extinguishing that futures contract by substituting it for actual physical metal or warehouse metal. And that's, and I show in the red line here where the open interest less spread positions would be had they not taken delivery. So you can see it's still sort of flat. It doesn't track it. And this pretty much suggests that the gold price follows the futures market and not necessarily physical demand, particularly physical demand from the warehouses at COMEX. And I'd say that's the main thing. The managed money traders are near the low. Well, they're off their max short position, which they were usually around, say, I think it's like 35% of open interest. They tend to sort of cap out, and we saw something similar in this recent low. So I watched that, but now they're starting to ease off that, but they haven't really gone long that much yet. And you can see, and this is the weekly data, so a change in open interest per group, and they've added to their longs a little bit, the managed money that is, and then reduced their shorts, but not really by a meaningful amount. So eventually, once the price gets galloping forward, then I think there'll be much more on the buy side, but just not yet.
So as you've tracked this data, Chris, have you seen any specific trends? Like, let's say you mentioned people standing for delivery instead of just rolling contracts over. Have you seen any trends over this past year, let's say?
Deliveries, not really. I mean, it's still the same high delivery amount as it was in the past. It's a little higher than 2021, so last year, but not as high as 2020, if you look on a year-on-year basis. And in terms of other things, no, it seems to be about the same. I don't see anything that's sort of flagging out, but it's just the normal cyclicality of it, I would say, is what we're seeing thus far.
Excellent. So did you want to kind of turn over to the other charts that you had prepared here?
Sure. Yeah, let me do that. All right. So I was just going to review last time. So just looking at the gold price, and that's kind of what I wanted to do with this set of slides here, is look at the gold price and give investors a way to sort of calibrate their expectations on where it's at relative to the cycle, where it could be going, and what have you. So last time I was on, maybe a year ago, I presented this idea that, which is probably not a unique idea, but maybe it was unique to me, and maybe it's unique to a lot of the audience, but it seems like other people do it, as I'll get into. But it's basically projecting historical prices forward and backwards in time using the scaling function, which is really growing by the money supply and discounted by the growth in the gold supply. So using this simple formula, and really the only input is the increase in the money supply, one can sort of track where the gold price goes, and it tends to be accurate over 100 years. So for example, this green line here, the top one, is associated with the price from 1934 at $35 an ounce when they revalued it. So I figure that's a good cycle high, and just projecting that forward in time using the scaling function. And then you can sort of map it out. And you can do this for other levels, such as this one. This is the $20.67 price from 1932 projected forwards. And then there's another one I call it the mid-cycle level, which is, I define it as the 1990 price, but one could pick many other prices and sort of get the same result that it sort of lines up. But the most interesting thing I would say is that you see I sort of put them in red dots here. It tends to, this mid-cycle level tends to function as a support resistance. So we can see it sort of tracking it within a few percent, the actual gold price, and multiple points. So I think there's like nine points here where it tracks it. And the most recent one was in the past few months, where it came down, within a few percent of it, and then it basically functioned as a support, and off it went upwards, which is where we're at right now. And then similarly for this mid-cycle level, or I call it the mid-high cycle, so that a price from 90 years ago is projected forwards in time, and it coincides with all the 7.5-year cycle highs. So we have one here in 70, 75, or I guess late 74, December 1974, 1987, and then 2008, March, and then the most recent one in August 2020. So it really can't be coincidence that this is all sort of lining up. So this is why I suspect that there's probably others who use this method and have probably used it for quite some time. And fundamentally, the gold price is considered money. So it does make sense to look at it that way. And the scaling function is really derived by looking at the market value, or making the assumption that the market value of gold, if the gold supply is basically proportional or equal, if you will, to that of the money supply. So if you make that assumption, you can quickly derive, as we did last time, this function. But we can see that it tracks pretty well. And if we sort of advance one slide, we can zoom in on the current period, and we see that triple bottom where it came down to a few percent of that mid-cycle level, and then now it's sort of come back up. And then if we take a really long-term view, and this is just looking at the mid-cycle line, and you can see into the actual gold price. So back to 1920, you can see it tracks it fairly well, and you can see that there's a cyclical overlay. So I mean, some people have said, well, this doesn't track the gold price on a day-to-day basis, which is true, but it tracks the trend in the gold price. And then there's a cyclical overlay one needs to sort of think about. So one can also see that there's a cycle to it. So if we look at the subsequent slide, we can see, so basically it's looking at the gold price, the actual gold price, dividing it by the mid-cycle level. So by getting that ratio, so when that ratio is 1, meaning that those two are coinciding, they're touching each other, you can see basically get this result here. And there's two things that sort of stand out. One, you can see the cyclical overlay to the trend. And the other is that we can see that the magnitude of the downswings, so this is 1970, is roughly proportional to the upswing in 1980, so a decade later. And then similarly for the downswing in 2001 period was roughly proportional to the, or basically equal and opposite to that of the upswing that happened in 2011. And then now we're back to this level. So there's some people, so if you look at this, there's sort of two identifiable cyclical periods to it, and they're not necessarily constant. So we have potentially a 45-year cycle, which would be 3 of the 15-year cycles. So 15-year cycles are known and are sort of well accepted. These really longer term cycles, I don't think I've heard anyone really discuss, but obviously if you look at the data, they're there. Well, I guess there's some people that have looked at it and they see that the 30-year cycle is sort of clear and present based on the 1970s data. But there's also this 45-year cycle. So we have 2 cycles potentially in the mix. Now, which one's going to be can one infer that there's going to be a low, 30 years from the, 2021 low? So that'd be like 2031. My guess is probably not. That's probably not what's going to happen. It's going to be longer than that. And in the next slide, I'll get to that. But one can also look at this pattern here. So we have, in technical analysis terms, one could say it's sort of a head and shoulders pattern. We have the left shoulder around $200 in 1974, December 1974, and then there's the head at 1980 high, and then it came back down to 283 in the 80s, and they all kind of line up with that sort of mid-high cycle. But you can see there's an up, down, or up, and then down, and then the price. And then one could liken it to this, but there's one difference, that we have higher highs. So we have a $1,000 price, almost 2,000, and even almost 2,100 here. So the price is still escalating; it's not going down. So for that reason, and the one I'm just going to get to, I don't think the 30-year cycle low anticipation of that in the coming years is likely. I think it's more likely going to be probably a 45-year. And if one goes from high to high, 45 years from the 1980 high would be around 2025. So it's getting pretty close, and other work would suggest that, and it doesn't have to be exactly 2025, it could be plus or minus a few years. But my target would be, probably 2027, 2026 timeframe. But, I guess that's sort of getting ahead of things. First, we need to get through where we're currently at. And the last thing I was going to mention was this is a chart, and I think in Gold We Trust report did something similar to this. So it's looking at the gold price and log scale on the left axis, and then the right axis the short-term real yields. So the gold price really performs best when the short-term real yield is negative. So this is an inverted scaling. So we have the negatives on the top and the positives on the bottom. So when it's gray, that means it's a negative real yield, and when it's positive real yield. So one can see that once you got that high, for the rest of the 2 decades following 1980, it was a positive real yield. So it's not really favorable for the gold price. But if you look at where we're at currently, it's sort of record short-term negative real yields, which is suggestive that we're not at a transition point where it's going to be going towards a cycle low, a long-term cycle low, that is. Yeah. Does that all make sense, Tom?
Yeah, I think so. And there's a couple of questions. Maybe if you go back to the previous chart, you mentioned the 1970s and that, let's say, inflationary environment. And I don't know if you have another chart that maybe better illustrates this, but I wanted to get your thoughts on if the 1970s was a good, let's say, analog for understanding how real rates affect the gold price, and as well as how inflationary expectations kind of fit in there as well.
Yeah, exactly. So in the next set of slides, I'll be touching on that.
Okay.
So maybe I'll just proceed and then hit on that. So that's right. So the way we just looked at was the money supply method of looking at the gold price, and that gives you a long-term view of where it's at within the long-term cycle. But if you want to get a little more shorter term, the other way to look at the gold price is in terms of the 10-year real yield. And I'm sure many of the audience has seen this chart. So you have a gold price log scale on one axis, and then the other axis, we have the TIPS 10-year real yield. And it's inverted. So negatives are on top, the negative yields are on top, and then positive yields on the bottom. So we can see there's definitely a correlation, with the exception being recently it's sort of diverged from each other, and we'll get to that, why that is, in one of the next slides. But suppose instead of thinking about the gold price as in dollar terms, we transition that to a real yield equivalent. So I'm sure most of the audience is familiar with how the mining companies sort of use like silver equivalent ounces. So they'll take the base metal credits or base metal production, convert it to silver equivalent, and then show that. So we're going to do something similar just to change our frame of reference. So instead of the gold price, we'll look at the real yield. And the relationship between the two can be sort of expressed as this exponential function. So you have the gold price, and then you have the negative real yield, which is inflation expectations for gold less the 10-year treasury yield. And then there's two A and B. These are just constants, which make the pattern fit. So if we do that, we can track where the gold price is at. So, and we can go one step further, not just look at the real yield gold equivalent, but we can find the inflation expectations equivalent for the gold price. Because we know the gold price, we know the 10-year yield, and we know the constant. So the only thing we don't know is the inflation expectations that would be implied by the gold price. So if you just solve for inflation expectations in that equation, you would get the following figure. So in gold, this is the gold implied inflation expectations. And then
that's the brown line?
Blue, that gold, the brown line. That's right. Yeah. And then in blue is the TIPS inflation expectation. So derived from the Treasury inflation protected securities. And then in gray is the CPI year-on-year inflation. So you can see we can see a few things. One, everything seems revolve around 2%, which is why everyone's there's a lot of talk of 2% inflation. Mm-hmm. And there's still expectations that, inflation will return to 2%. And the other thing that is noteworthy is that, one, the CPI is sort of, they're all different measures of inflation. CPI is looking at from the past to the present. So it's 1 year ago to today, or whenever it's taken, what the inflation is, what that inflation year-on-year increase is, as opposed to the TIPS inflation expectation and the gold implied 10-year inflation expectation. Those are looking at from present to, say, 10 years from now, what the average inflation expectations or inflation expectations are for that period of time. So it's not unheard of, or it's not inconceivable that you're going to get a divergence between the expectations and the CPI, just because one's measuring a very short-term look at inflation, while the other one's sort of projecting in the future what they anticipate inflation being over a longer period of time. Mm-hmm. So we can see that they roughly track each other. The good thing about doing it this way, not only you get the TIPS inflation expectation, but the gold price is sort of another way to look at it. And we know that there's a lot of different ways you can measure inflation in general. You have the PCE inflation, CPI inflation, GDP deflator, producer price index inflation. So there's just many different ways to look at it. And the market also has its many different ways one can express inflation expectations. So here's two of them that we have, the TIPS and then the gold price. Mm-hmm. But so the gold price and the TIPS inflation expectations are quoted daily, or even, within the day. So one can derive this as opposed to CPI data, which comes out monthly and usually lagged by 1 month. So you can sort of get a sense. In some cases, you can see the peaks in the gold inflation expectations precede that of actually CPI inflation. So one could potentially use it as an early indicator of where CPI is going, assuming you're in that equilibrium position where everything's sort of stable around some level, such as 2%. Mm-hmm. Now things are not stable, so it may not be exactly the same. But I was just going to highlight that. So if we zoom in a little bit on what we have here, and actually, so basically what I wanted to talk about now is this divergence that we've seen recently, which started in March of this year. So what caused that, and how can we sort of look at that? Because a lot of people were thinking that,
Chris, divergence between the 10-year and the gold price, right? 10-year real yield. I'm just thinking for those of our listeners that are only listening on audio, it'll make a bit more sense to them.
Yeah, definitely. Yeah. So this is a 10-year real yield. And so usually it tracks the gold price. But since March of this year,
pretty highly correlated. And then since March, as you say, they diverged quite significantly.
That's right. Yep, they diverged quite significantly. So why is that? I mean, so some people were saying, well, the gold price is going much lower, and this is the early indicator, and it's just a matter of time that's going to happen. Well, so there's more to the story than that. So we can sort of zoom ahead and look at what the gold price is really saying relative to other measures of inflation. So here we're plotting the inflation expectations based on gold, the TIPS, and the CPI year on year. And we can see that breakout in March that happened occurred when the CPI inflation was over 8%. So the gold market was basically saying that, we got to start pricing in more inflation than what the TIPS market is doing. And what you see is sort of oscillating. There's a cycle to it. There's a trend upwards for gold-based inflation expectations. And currently it's at 4.35% as of Friday. Whereas CPI inflation, so this is Monday, so this is before the CPI comes out tomorrow on Tuesday for November, but it's currently in the high sevens. So, but obviously, it's most likely going to be still north of 4.35%. So, when one looks at the gold price, it's not inconceivable to think that this can continue to trend up even as CPI trends down until they sort of find an equilibrium and maybe they roll over if there's when you get to a deep recession. Mm-hmm. But for now, it seems like that this separation is very wide, and there's still a lot of room for it to continue to go up. So as for the TIPS inflation, so what is it saying here? it sort of got to 3%. It touched a few times, 3% inflation expectations from the 10-year. I call it 10-year inflation expectations. Some people call it the 10-year break-evens, which I don't know. I sort of use them interchangeably, but I'll just continue to use inflation expectations because it sort of makes more sense to me. Mm-hmm. So anyway, it went there, and then it's sort of trended down since. So now it's at 2.26%. So that's what the TIPS market is sort of pricing in for inflation expectations over the next 10 years. So why is that? And the simple answer is I don't have an exact answer, but I can sort of throw out some ideas on why that could potentially be. So one possibility is that it's sort of widely known that the TIPS market is more illiquid than, say, the general treasury market. So the TIPS market is 1.8 trillion. Of that, the Federal Reserve owns about 0.3 trillion of that. So maybe there's like 1.5 or so that's owned not by the Federal Reserve, so it's outstanding. The other issue is that the TIPS market tends to be bought by sort of buy and hold investors, so they're not really trading it, so that reduces trading liquidity for it. So there could be, there's usually a discount to the TIPS market relative to other markets. So it's sort of known that one can expect it not to be trading exactly based on expectations. And the other possibility, well, I guess one could also add that the treasury market itself, the non-TIPS treasury market itself, is relatively illiquid. And there's some sort of Federal Reserve staff articles and papers that have discussed this, whether it's due to the Fed being a large buyer and now they're being a seller into the market, the supply going up, or the banks not being involved, what have you. There's many explanations for it, but that could also be a contributing factor. And one other possibility is that the Wall Street inflation forecast, this is a chart from Bianco Research. So it's not a chart from me. This is a Bianco Research. So he looked at the inflation expectations or inflation forecast for the Wall Street economist. And you look, they're all sort of, whatever point in time you pick, they're always going back to, let's say, that 2 to 3% range. Mm-hmm. So it's possible that the TIPS market
within 2 years, right?
Within 2 years, yeah. Mm-hmm. But if you're looking at inflation expectations over the next 10 years, then you can say, well, then that's believable. So if these forecasts were to prove out, then one could say, yeah, maybe the TIPS inflation is accurate. But you can see that, that there's many instances wherever you pick from 2001 forwards, the present, all the curves are sort of trending back down to that sub 3% level. So it seems to me that the TIPS market is basically believes, or the traders in the market are more conducive to that idea that inflation expectations should be trending back down to 2%. So the idea that there's that the inflation is transitory and it's not going to stay sort of at an elevated level they're still grasping on that the Fed has control of the situation, whereas the gold market seems to not be believing that as much. Mm-hmm. So I guess you have different traders in each market, and they're sort of believing different inputs. And that's probably the best way I can put it on terms of why there's that divergence here between one versus the other. But nevertheless, I think if someone has the view that inflation is going to go up or continue to trend up, or say elevated, maybe not trend up, but remain elevated CPI inflation, then the gold inflation expectations could also continue to trend upwards, until they reach some convergence point. Mm-hmm. But if one has a different view, then one can use this method to figure out what the gold price would be based on whatever assumptions they have in mind. So it's another perspective of looking at the gold price. We're looking at through inflation expectations now, as opposed to just the price itself or technical analysis or something like that.
It really seems like it's just two different vehicles. We had one of your subscribers ask about really the difference between the TIPS market and the gold inflationary expectations, basically. And it's, it seems to be almost two different sets of investors. And the TIPS market has a lot of converging complications with it versus more pessimistic gold market, right?
Yeah, I would say so. That seems to be the explanation. I can't necessarily prove it, but that I would agree with that. It seems to be that's the case, that there's just two different interpretations. But one would think that eventually one's going to be proven right and they're going to reconverge at some point. When that is, I'm not really sure. But yeah, one could sort of come to their own conclusion on that. Yep. So there's the second aspect of looking at the gold price. So if you have higher inflation expectations, you expect the gold price to go up. And the other aspect of that is the 10-year yield, nominal yield. So if you have a falling 10-year nominal yield, you can expect the gold price to also go up. And then vice versa. So if those things are going the opposite directions, then it's bad for the gold price. So as we just said, one could make the case that inflation expectations should continue to trend upwards based on the arguments just presented. And then looking at the 10-year yield, what's that doing? So right now, what we have is a October high of 4.21%, and since then it's sort of been trending down. So the reason why it's trending down, in general, when you ever get conditions like this, is that it's anticipating lower future short-term rates. So if rates in the future start to go down, then by the sort of the math of it, you have to have lower long-term rates, and that's kind of what it's pricing in. I suspect that this is probably the high. I don't think it's going to go higher. And one of the reasons is because I think they're pretty much, the Federal Reserve is near the end of their rate hiking. And we'll probably know more in the next couple of weeks to see how the market responds to the next 50 basis point expected hike in rates, which would get up to 4.5%. If the 2-year and the 10-year continue to drift down from there, that may be a good sign that it's hit. So basically, there's two drivers for the gold price under this framework. There's the rising inflation expectations and the falling yields. So we're kind of at that point where we could have both of them in play, meaning inflation expectation could continue to go up and the 10-year yields can go down, which is positive for the gold price. And in the next chart, we can quantify what that would be. So this is plotting the gold price, and we have inflation expectations on the x-axis. So we can put where we're at, and then I guess these contour lines, as I call them. So looking at the brown one here, this is what the gold price would follow if we fix the 10-year nominal yield at 3%. So for example, say you're at 4% inflation expectations, that would imply a gold price of just below $2,000. But if you were to go up to 6% inflation expectations with a 3% 10-year nominal yield, then you're just below $3,000. So it's a quick way you can sort of map out where the gold price is, where it could go based on the assumptions of different inflation expectations or 10-year yields. And the other thing we can see on this chart is that there's a convexity or a nonlinearity to the gold price relative to inflation expectations. So you can see as you get higher inflation expectations, say up to 10%, you can see very dramatic moves in the gold price. Getting up to $6,500 or so, and also if you look at the yield, drop the yield down from 3% down to 4%, then you go down to closer to 5,000. So it's just a quick way to look at it and see where things are. And does it make sense? And if it doesn't make sense, then maybe it could be a top or a bottom in terms of the price. And it's one way to look at it. So if we zoom in one more time and look where we're currently at. So here's if we use this sort of framework for looking at the gold price, we have 1808 was the close last Friday. And then at the low on November 3rd, the point on this chart would be here. So it follows a circuitous path to get to where it's at. And it's basically suggesting that the gold price has been driven by a fall in the 10-year yield. So there's really, which is positive for the gold price. So inflation expectations based on gold-based inflation expectations have gone down by a little bit. So the main driver has been a fall in yield. One can sort of map what they expect. So say from here, say that the inflation expectations remain fixed and the 10-year just continues to go down to 3%. So one can just draw the line up to here, and then you're at basically almost at the all-time highs around 2050, $2,050 or 2050 as a price at a 3-year nominal yield. If you take it up to if you drop the 10-year down to 2%, then it's kind of off the chart, but it's a little above 2,500 for the gold price. So again, this is just a quick way to look at it and see where things are. If you look at the beginning of the year on January 3rd, it was here. So we're above the 2% 10-year nominal yield, which suggests that at this point the yield was probably like 1.8 or so. And then it went all the way to here. So we had a large increase in inflation expectations, but we also had a large increase in the 10-year nominal yield. So those kind of offset each other to a certain extent. Right now, the gold price is about the same level as it was at the beginning of the year. So it's almost unchanged on the year. But if one thinks that inflation expectations could continue to go up, then you can sort of map it out upwards like this. And then if nominal yields fall and so forth.
So Chris, do you think it's like algorithmic based trading that is making that calculation based on the 10-year, or, are bigger investors taking that into account? Like, how do you explain the actual price action based on that correlation to the 10-year?
Yeah, I do suspect that this is by the big investors who are probably doing algorithmic trading. I'm sure they look at this because they're sophisticated. They've been doing it for a long time. I'm not really a professional at this. I'm sort of just doing this on the side. So if I'm figuring it out, I'm sure they figured it out a long time ago. And I would suspect that they're also pricing it based off a similar equation, and probably even maybe more advanced ones than what I have here. Because there's many different ways to look at inflation. So the next thing I was going to discuss is just the gold price in general. So what we see if we look from the start of this bull market, this chart starts in 2004, the gold price tends to go from one consolidation level to another. So we see here it consolidates and then up, consolidates and then up. And then we have the cycle low for the GFC, and up, and then flat, and consolidate, up, and consolidate. So then we're at the point in time where we expect the next sort of transition from one consolidation level to another. Now, if we look at the past, usually the minimums they come is around 50%. So it was 50%. Well, that's the one I'm expecting. But so this was 50%. This one was greater than 50%. This one for the up to the 7.5-year cycle high was about 48%. So roughly 50%. This one is a little above 50%. Now, if you go from 50% above where this consolidation level is at, and you're going to get to around $3,000 an ounce. And the audience probably knows that through technical analysis, if you do the cup and handle pattern, it would also suggest a price target at a similar level. And it also sort of lines up with the cycles, which we'll get into later, with the 7.5-year cycle high and then essentially a low where it comes back down and retraces it. So the previous instance where we had a cycle high, 7.5-year cycle high to the low, was during the GFC. So you saw the gold price go up by 50%, then it came down and almost to that consolidation level, and then trended back up and then continued its advance. So what I would like to do is look at the historical analog of this period right here, and in this one. So what drove the gold price in both of these periods? So this moved from 2007.
Yeah,
2007 to the 7.5-year cycle high in March of 2008. And then again from the late 2009 to the high in September 2011. So what was the drivers for that? So we'll go to the next slide for that. So it's basically, I'm going to break it up into different periods. So we have this A period, which is that 2007, that high in 2008, March 2008. So if we look at that first, and we look at again, it's the 10-year treasury yield. If it falls, it's good for the gold price, or if inflation expectations rises, that's good for the gold price. That's the driver. So what we see here is that the 10-year yield started at 5.2% roughly in July of 2007. So right when it broke out. So that breakout period right here we're looking at. So you take that period that where these values are at, and then to the end where it reached the high, we see the 10-year yield fell. So we can say definitely that was a driver for the gold price going up during that time frame. As for gold-based inflation expectations, they were pretty much flat. So they didn't really contribute much to the advance in the gold price during this period A, as we call it. And then we have the GFC, and then it comes back up, and then it breaks out again above the consolidation level. And then what drove the gold price there? Well, it's a different thing. So now the 10-year yield's flat, roughly, slightly going up. So that's slightly negative for the gold price, but one could say it's just roughly flat. And it was inflation expectations going from 1.5% up to 3.2% during that period, which what drove the gold price. And then for that final move up from here up to the cycle high that some of us remember from September 2011, when it got to 1923 or wherever it got to, I think it's 1923. That one was driven by yield going down again, and inflation expectations also traded down. So that's sort of a negative offset to the driver for the gold price. And to summarize, so we have in period A, it was driven by a falling 10-year yield. B is driven by a rising inflation expectation. And then C is driven by a falling 10-year yield again. So one can go back through time and look at all the different cycles and see what was driving it, what was not. If you go back to the 70s, it was all inflation expectations that were driving it, because the 10-year yield, it was either flat or up. So it was a counterweight to the advancing the gold price. So it's just it's a unique, or it's a perspective that one could take in terms of looking at how to think about the gold price and what were the drivers of it, and does it seem like the drivers are positive or negative at that point in time when you're looking. Mm-hmm. So that's where the thinking on the framework. So this chart here is looking at the Fed funds rate, and the reason I'm looking at this is that it turns out it's useful as a timing tool for getting the cycle highs and lows for the gold price. So since the low that we had in 2001, this is a cyclical low. So when the bottom of the bear market, so almost 22 decades ago, we've had two full interest rate cycles. So we have this one here, it goes up and then down, and then the one in 2016 to 2020. And now we're almost midway through the third interest rate cycle. Now, if you mark so in the red line is the Fed funds rate in dark red here. And in the pink is the 2-year treasury yield. And what we see is that, and as Jeff Gundlach likes to point out, the Fed doesn't really need to do much. All they need to do is follow the 10-year yield. Mm-hmm. Because you can see every time the 10-year yield starts to go down, it's pretty much the end of the rate hikes. It tracks it, and also it sort of includes the end of it. So once it starts to go below it, the Fed funds rate, then that's usually the marks the end. So we see that here. We see that here. They stopped raising once it started to trend down below it. We see that here. So they hiked it, and then it went below it, and then never hiked it again. And if we zoom in for the next chart, so the Fed is most likely going to hike it up to 4.5. So unless the 2-year continues, or unless it goes up, if it continues to trend down, that's probably suggesting that was the last hike, based on the historical data that we just showed. So it's useful to watch that. Maybe there's more, but you just got to wait and see. But that's sort of something to keep in mind when looking at it. Going back to this chart, so if we look at the top of the 2-year, so in this case there was a double top, but if you take the second one, so when the Fed funds rate reached its low, we can see that encapsulates the transition period from one consolidation level to another. And then similarly for here, so we have the peak in the 2-year in the 2008 period, then it comes down, and the Fed funds rate reaches its low in early 2020. And again, that sort of encapsulate a portion of that transition period from one consolidation level to another. And we're sort of on the verge of, again, the 2-year peaking, if it hasn't already. And If so, then you expect the transition period from this consolidation level that we've been in for 2+ years to give way, and then we'll be on the doorstep of the next move up to potentially $3,000 per ounce.
Yeah, it's interesting to see kind of that correlation between the 2-year and the Fed funds rate, and then gold's subsequent advance after that.
Yeah. Yep. Yeah. I mean, had I known this like a decade ago, I think I would have performed better than I did. But
that's a really interesting chart, Chris.
Yeah. So now that the audience, the younger members of the audience, or even the older ones, such as myself or older, they'll hopefully find it useful that they can sort of maybe time the market a little better than at least I have done in the past, and probably everyone, most people in general have. Mm-hmm. So the other way we can look at it is if we map the gold price at particular points onto the Fed funds rate cycle and see what we see. So what we have here is from 2015, where the Fed funds rate with the stair steps up, and we're putting markers on the Fed fund rate at particular points. So, for example, when the 10-year reached its peak. So it reached its peak in this 2015, the 2020 Fed funds, or the Fed funds interest rate cycle, in November of 18, and it was just before the last rate hike. And then they paused, and then they started cutting rates. And then what we get is the local high in March, around 1704 is the high for the gold price. So it's midway through the rate cutting phase. And then by the time the Fed fund rate reaches its low, basically a week later, because the COVID shutdown really accelerated things. So about a week later, you get the low, about $200 or about maybe $250 below the high. You get the low, and then there's the stimulus, the fiscal and monetary stimulus, and then it pushes gold up to a high. So just sort of mentally take a snapshot of this sort of sequence of events, and we'll just see it repeat for these previous cycles. So we're looking at this one right here, which is a 2016 to 2020. So if we go back to the 2004 to 2011 interest rate cycle and see how that one looked, it follows a similar pattern. So we have the rate hikes. They pause. The Fed funds rate pauses at just above 5%. The 10-year reaches its peak, and then the Fed funds rate starts to go down. And again, midway through the rate cutting phase, you have the high, 7.5-year cycle high for the gold at just over $1,000 in March of 2008. And later in the year, you get the global financial crisis, and gold reaches its cycle low near the bottom when the Fed funds rate near its low, around 681. Mm-hmm. And then you have the stimulus again, and then you have another cycle high. So that's the pattern. It's almost like if you go between the previous cycle and this one in 2004 to 2011, they sort of follow the same pattern with the cycle high occurring in both instances midway through the rate cutting phase, and then the low occurring near the end of the rate cutting. So that covers that covers all the advancing period from 2000 to present. And we can go back to the 70s and see what the gold price did during that interest rate cycles during that period. So here's the effective Fed funds rate. So it's a little noisier, but it's the data right off of the St. Louis Fed's Fred website. But so here's the Fed funds rate. It goes up, it reaches its high around 14%. And yet again, midway through the rate cutting phase, you get the cycle high for gold at just under $200 an ounce on December 30th, 1974. And then we have a low that comes subsequent to that after the rates have sort of stabilized around 5% at basically half that price. So the sequence of events, as you see it, is sort of 3 for 3. The cycle high for gold comes midway through the rate cutting phase. Now, I should also mention that all these cycle highs, when you're in the middle portion of this rate cutting phase, that's during a recession. So all of these highs occurred during a recession, the early part of a recession, as defined by the NBER. And And I know there's been some people suggest when the gold price is not going to do well because it's, we're going into a recession. But, the data shows that actually it is during the early part of the recession that the gold price does its best. And the reason is because of the lags in the economy. So they're hiking rates, the Federal Reserve is, they get to a point where they stop, but the full bite on the economy hasn't really kicked in yet, and that's delayed. So you still have elevated inflation early part into the recession, all the while the 10-year yield is trending down because the bond market's pricing in lower 10-year yields or lower short-term future short-term yields. So the 10 years going down, and inflation expectations remain elevated. So it's a temporary sweet spot for the gold price, because as we looked at in that framework that we talked about in the previous slides, if you have high inflation expectations and falling 10-year yield, that's the best of it. But eventually, the lags do catch up with the economy. Inflation expectations start to go down, and the 10-year yield is probably already at a low. So then you get the subsequent low in the gold price. And in recent periods, then that triggers the stimulus from the Fed and the fiscal stimulus, and then you get another cycle high. So I suspect that's probably what we're going to get. So one could set the expectations that if we get to the $3,000 gold price, it'll probably midway through the rate cutting phase if history repeats. If one thinks it's not going to go that high, maybe it goes to 2,400. So be it. But either way, I would say the sweet spot for gold is coming up. It hasn't happened yet. And in the low, if things happen as expected, then that would come subsequent to that. And this sort of fits in with the 7.5-year and 15-year cycles for gold price. So this is a slide that I presented a year ago on the show. And basically saying that if you look at the previous 7.5-year cycles, there's a certain distribution for the periods between one to the other. And that would put, if one sort of projects that forward, that would put the next cycle, 7.5-year cycle low for the gold price between July 2022 and mid 2024. So that's kind of a broad range of 2 years. So it's not as useful. And I think some of the audience from that show a year ago were expecting it a little sooner than it came, in terms of expecting a higher gold price sooner than so far it has. But obviously we haven't got there. We're still in the consolidation period. But if one adds into the analysis this cycle work, where the expectation for the gold price high is going to be midway through the rate cutting phase, that sort of narrows the window down, but it's also still in agreement with these cycles. So if you get a high in mid to late this year, then you can still get the low by, say, early 2024 or late 2023. So it does make sense. It's just it depends on what you're doing. So this is a more refined way to look at it. So using what we've talked about, using the framework of the inflation expectations and the 10-year yield being the driver for the gold price, how could this play out? So here's one possibility. It's not saying it's going to happen, but just sort of studying the previous instances of how the cycles have played out and what's driven them. This is kind of what I'm kind of thinking. So here's where we're at right now in the gold price. So we're at the inflation expectation around 4.3%, and the 10-year yield is around 3.5%. So it's potential that we have a continued rise in inflation expectations up to this level here. So keeping the 10-year yield still around the 3.5%, and you get into this A window, and that's around $2,250 per ounce. So a new all-time high. And then from there, then the Fed pauses, they start cutting rates, and then the 10-year yield falls, as it's typical during that late portion of of the cycle. It falls, and if it falls down to, say, the high 2 or the low 2% range, then you're up to the $3,000, which is conceivable. I mean, one could come up with other sort of paths that it could take to get to wherever they think it could go. But this is just one that I'm throwing out there based on sort of looking at the data and making a leap forward.
Yeah,
and if one looks at this, yeah, go ahead.
I was going to say that kind of, plays a little bit towards that idea of a possible $3,000 target for next year, right? Like just
That's
one
right.
of
Yep.
those contributing factors that can help drive the gold price to that
That's right. Yep.
ultimate
Yep.
target. Yeah.
Yeah, it definitely seems within the realm of possibility that this could play out like this. But the future is always unknown, so we don't really know. But what we do know based on history is that the high is still ahead, so one can anticipate that, and the low is likely in based on many as the points made, and one being the money supply charts where it shows it hitting the mid-cycle level 3 times and bouncing off of it within a few percent. So when it gets to $3,000, then if history repeats, then you have the interest rate hikes start the bite on the economy and the things slow down, and then inflation expectations could fall. And if they did, and you get gold price back down to $2,000 an ounce, that would correspond to an inflation expectation of around in the low 3% range, which is also not unreasonable. It's not aggressively low or high. So that's kind of the way I'm thinking about it, but it's open to refinement as we go. So one other set of charts I wanted to go over is just looking at the stocks, the HUI index, and it's an analog overlay of how the HUI index performed during the previous interest rate cycle. Mm-hmm. So in gold or in yellow, you can see the current HUI gold bug index for the gold stocks, starting from say the early 2020 to present, and then going back to the previous interest rate cycle. So the analog overlay, we're looking at the 2016 to 2020 and seeing how that behaved. So I didn't just willy-nilly just line these up so that it matched as best I could. I tried to have it in phase with the interest rate cycle, and to show that here's the 10-year yield using a similar analog overlay, and you can see that also sort of matches up. So I've seen some analogs where they match it up, and it's a completely different portion of the interest rate cycle. Maybe interest rates are falling or they're flat, and yet the current scenario has them rising and towards the peak. So I think that's not really a good way to do it. So if they're in phase with each other, I think it's a more sort of honest way to look at it. And it turns out that if you look at the current overlay, they look to match both on the 10-year yield, which are nearing the peak. So it's also lining up with that, and also the HUI index. So there was some talk earlier in the summer. I was getting questions from some subscribers about the gold the stocks are suggestive. They're leading the gold price, and they're suggestive that it's going to go a lot lower. And there was a lot of technical analysis that was suggesting maybe they're looking at the real yields as well, suggesting that gold price is going lower. And I was saying, wait a second, if you do the analog overlay, it's really no different than the last cycle for the gold stock. So it's hard to say that they're really telling us anything different than is sort of the normal for them. Mm-hmm. And you don't have to go back too far to find this. It's just the last interest rate cycle. So we can see it's pretty much mapped up with it again, because this is where it's at right now. So I think it looks good. I think the things are nearing the point where the rewards start to come for the gold investors, although it's perhaps longer than many of us anticipated. Maybe some thought, including I thought it would come this year, but it looks like it's a 2023 event for that high. Mm-hmm.
Yeah, I think those that have been able to be patient through this time period, and there's so many times where gold has been said that it is a great hedge for inflation. There's so many different aphorisms that are always offered, but I think being able to go through data like this, adding to that weight of evidence, is really valuable to get a better perspective on where we are and hopefully where we're going.
I agree with that. Yep, exactly. Because having that confidence when things are going against you to either add to positions or at least hold them mm-hmm. is a valuable position, because otherwise one could be just whipped around by the markets and opinions that others are expressing, which could be right or wrong, but having a multi faceted perspective on where things are at, you probably get a much a richer opinion on what you think. The last chart I was going to conclude on was this one. So let's look at the S&P to GDP ratio, and I think it's much better to normalize it than looking at the S&P directly, because you can see the cycle to it, and it's kind of akin to a price to sales ratio for stocks. So when it's high, means that when the cycle is high, when the S&P to GDP ratio is high, it's probably not a good time to buy. It's probably near the cycle high. And subsequently, when it lows, it probably is a good time to buy if the price to sales ratio, or in this case, the S&P to GDP ratio, is at a low. So you can see that there's a cycle to it. And right now, the cycle high we just had in 2011 is only really comparable to that which happened in the 30s. So you have to go back pretty far to see something this overvalued. The other thing that kind of lines up with it is this inflation. So if you do the CPI inflation 5-year annualized, so you look at 5 years in the past to the present CPI level, and then you annualize that whatever that changes, you can see that the inflation tends to peak at these troughs when S&P to GDP ratio reaches its low. In fact, the peak in the CPI 5-year annualized percent tends to be 2 years preceding, 1 year in this case, but 2 years in all the other cases, 2 years preceding the low in the S&P to GDP ratio. So if history is, or if this time's not going to be any different, and one can sort of look at the cycle period. So usually the S&P to GDP ratio goes with a 26 to 34 year cycle. So if one sort of projects that forward, then you have the next trough in S&P to GDP in late 2030s to early 2040s. And if the CPI is also going to do the same thing, then we could expect inflation to be elevated and reaching its peak sometime in the 2030s as well. Mm-hmm. So all this is sort of good for the gold price, not just this decade, but also into the next decade. Mm-hmm. So it's just something to keep in mind, because if you look at so here's the S&P to GDP ratio and S&P to gold, and you see those two ratios pretty much track each other. So one could basically capture that move down by being long gold. And the other thing to point out is that S&P to GDP ratios, so this is if you look at the scaling on the left side here, that's 1 order of magnitude, as opposed to the S&P to gold ratio, that's 2 orders of magnitude. So it's basically 10x the leverage that you would get if you were sort of hypothetically short the S&P and long the GDP, mm-hmm. which is what you would think about if you wanted to sort of to trade that. Obviously, there's really no way to trade the GDP, but you can definitely trade the gold price. Mm-hmm. And if one really wanted to sort of follow this chart, although I'm not suggesting one would, but one could short the S&P, go long gold, wait 10 years for it to reach its cycle low, and then release that position. But there's gonna be a lot of wiggles along the way, so I wouldn't recommend that. It's probably easier just to go long the thing that's going to do well, which is it's going to be the gold price. Yeah.
Well, Chris, one of your subscribers, Mark, kind of asked about something along those lines. And that's how you think about trading in and out, or I guess if you think about trading in and out of gold based on those 7.5 year cycle lows and highs. So what are your thoughts towards using that as a framework for when to invest and maybe when to sell?
Well, I think, going forward, so in the past, I didn't really have as clear of a picture on all this as I do now. So I hadn't done that historical research. But with that said, going forward, I would probably, if we do get to 3,000 high, and it does look like things are playing out as expected, selling some of the positions and hedging. So I'm mainly in the stocks, gold stocks, and the producers. Mm-hmm. So selling those down and hedging the positions, or hedging the positions with put options, would be probably the way I would do it. Now, there's other traders who are going to do much more advanced stuff, and that's definitely okay. And as for physical gold positions, I don't think I would sell any of my physical gold positions.
Mhm.
And probably the best thing to do there, if that's a large portion of your portfolio, you can definitely hedge them. But it's really up to the individual on what they want to do. But that would be my preference if I was in their shoes.
Mhm.
Yeah.
Chris, have you done any analysis around trading, let's say, in and out of different metals based on the ratios as well? Let's say the gold and silver ratio.
Um, I don't do much trading, so I just look at the stocks, and if they're really undervalued, whether it's gold or a silver stock, I'm gonna basically go with that. And yeah, I maybe it's better for a trader to answer that question, because I just don't do much with that.
Yep.
I mean, what I do look at though is the gold to silver ratio within the cycle, and to see how high silver could potentially go.
Mhm.
And if you look in the 70s, it sort of made a brief high, and I think it got into maybe the 20s or so. But in the previous cycle in 2011, it maybe got down to the 30s or 40s. So, and usually once it gets to that peak, it's probably near the end of it. In terms of the current cycle, I was thinking that silver is probably not going to do its really big move until like the second half of the decade. So say 2024 to 28 or so. And just because that seems to be how things go with it. So I could definitely see the silver price getting up to the highs that they were at previously, and then come down, and then make that really big blast off move in the second phase, where gold price would probably get up to potentially 8,000, and then silver going, 200 or whatever, whatever it is. Yeah. But one could look at it, just look at the ratios and see where it went previously. So say put a 40 multiple or 40 on that, that's $200. So $8,000 gold divided by 40 gets you around 200. Yeah.
Well, exciting stuff if you think about where that could get to, and again, the weight of evidence behind actually getting there. I really appreciate you sharing all that data and all those charts with us, Chris. Of course, that's all available on your Substack, GI, or for gold investors, giresearch.substack.com. Are you still active on Twitter?
I'm still active on it, but not as much so. So I don't post as much, but I definitely post a little bit, and one can still contact me or follow me through Twitter, and they'll get. Yeah, go ahead.
I was going to say that's at C Rutherglen.
That's right. Yep. Yep.
Wonderful, Chris. Is there anything else you'd like to share with our audience before we wrap up today?
I think that covered it. Yeah, thank you, Tom. Yeah, I think that covered most of it.
Yeah, that was excellent. Thank you very much, Chris, for that, thorough review of all your research, and really in some ways a passion side project for you.
Yeah, well, at this point, it sort of makes more money than the day job. So as long as that's going to continue, and also it is a passion. So you really need to keep on top of it, and the more you learn, the better you are at sort of timing the cycles. Because coming as a value investor, I was more in the point of view of Warren Buffett, buy and hold, but that doesn't work when it's in the mining industry, because they're not really great companies in the sense that they have pricing power. They're price takers, so you just kind of have to sort of ride the cycle. So if you can understand the cycle, then you can sort of time it. And the volatility is so high with the gold price and the mining companies that you can get outsized returns by just sort of riding it up and then sort of stepping out when it reaches its high.
Yeah, that's an excellent point, Chris. I really appreciate you sharing that all with us today. Thanks, Chris.
Yeah, you're welcome, Tom. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.